Finding a stock that could be a 100x and fantasizing about the upside is fun and all, but it's very rare that you will actually make good investment decisions using this strategy. What should you do instead? That's what we're going to talk about in this video. I'm Amateur Investing, and my videos cover companies I'm personally invested in, general investing, small and microcap analysis, education, and financial freedom. Let's get into the content. So let's start with a little overview of what we are going to cover in this video. So I'm first going to tell you guys about how I came up with the video idea, and I will share my painful investment journey up to this point and things like that before I tell you about the number one rule. And at the very end, I'm also additionally going to give you guys 4 tips on how you can apply the information that I'm going to be covering in the video to your own investing journey. And I think this is going to be, the most valuable part of the video. So, guys, stick around if you want to get the real, the real value here. But obviously the number one rule is also like something that I personally learned through, blood, sweat, and tears. And yeah, it's just something I want you guys to know about. So here's how I came up with the video idea. So obviously, like we all did, we all had badly performing investments, and I had some companies like really doing very, very badly. And I asked myself, what do they have in common that I can maybe find out so I can avoid companies like that in the future, or if I have them in a portfolio, how I can figure that out and sell them. And obviously, I don't know if this strategy is super watertight and works exceptionally well, but so far in my new approach, it seems to work better than my previous approaches. So at least there's that, and I want to share it with you guys so you guys don't have to make the same painful mistakes. And this video was one of 4 video ideas that 24 of the most hardcore viewers voted on, and this video idea won. So if it turns to be bad or boring, blame them, not me. Obviously, I'm joking. Like, I just had like 4 ideas that I all was willing to make, but wasn't sure which one would gather the most responses. And some of the ideas got almost no votes, and this video won with pretty overwhelming numbers. So yeah, this is why I'm doing it. So let's look at my painful investment journey so far. Most people don't like to talk about this stuff because they want to portray themselves as, oh, I always make, super perfect calls and all my investments go up 20x instantly. No, like, we're all human, we learn over time. Obviously, at the very beginning, I was absolutely terrible investor, but, by now, I'm still not perfect, but, I've gotten quite a bit better, I would say so myself. So when I started microcap investing, and, microcap investing was the first type of investing that I ever did. Or, it was like technically like small cap, or was still a pretty small company. And, back then I was only fantasizing about all the upside and how much money I would make once the company took off. And the worst thing obviously happened, which you guys know, my very first investment actually went very well, which is very dangerous, right? It was like on a different brokerage account. So, I could look it up, but, it was like a 2 to 3x in a year, and, made me overconfident. And it was even worse than that. Not only did I get like this massive boost of undeserved overconfidence, but also right after I sold, shortly after the company cratered like 30-40%, because there was an upcoming catalyst, which I was excited about. This was why I was buying the company. And then, close to the catalyst, I'm like, oh, all of the upside is already priced in, let me just sell. But then, the catalyst actually turned out to be very, very underwhelming, and the company crashed like 30-40%. So I was feeling very smart at this point. And, just 2 years after that, I came extremely close to almost blowing up my entire account by, speculating on macroeconomic events with very high leverage. So this is why nowadays I'm very careful about leverage, because, I got burned very heavily once and it was enough for me. So, I'm now very careful. And if I use margin, I use it like very, very sparingly and only like very small amounts. And, my account, I think it was going down and down and down. And I think I ended up at like $2,000 was at my very lowest. Then, it rebounded a little bit, but, I almost lost my whole account. But, by that point, my account wasn't that large, but it was still like emotionally was extremely painful to almost lose your whole investment that you were investing like, the last 5 years. It was very, very painful. And afterwards, I made many more mistakes, obviously, especially in microcaps, because I didn't pay enough attention to the downside. Macroeconomic exposures and CEO promises that required them to do something extremely outside the norm for the company to succeed. So, all of our competitors, for them it costs $300 to acquire a customer, but because we are so amazing, we are for sure going to figure out a way to get customers at $30. So at like a tenth. like, yeah, if you do that, then, oh, the company's revenues are going to grow 10x, and then they can recycle the money that they get and grow super quickly. And then, obviously this didn't happen and the company went close to zero. And, things like that, like macroeconomic exposures, CEO being like a slick talker with like a bad past, where, in the past he was doing like very shady stuff, but you ignore that things, right? Like, oh, he changed. Oh, it doesn't matter if he had a shady past. All I care about is making money, and this guy will make me so much money. Yeah, then you just ignore this type of stuff, right? Like, yeah, you just get greedy. You only have the, like I took here, fantasize about the upside, or, once people realize how crazy amazing this company is, it's gonna, like, you focus on the wrong stuff. And most importantly, you don't do enough due diligence. You don't understand the whole business and everything, super well. You understand like most of it, but the things that you don't understand is typically what really, really fucks you over. Yeah. So you come to the number one rule. Again, this is a rule I personally came up with. I didn't read it anywhere. It was just me painstakingly going through my failures and trying to find the commonality. And I think this is like the best I could personally come up with. And it's a little bit more, complicated, but once I explain it, I think you will understand what I'm talking about. So the rule is, what is the chance that I'm completely wrong about the main thesis? And if that chance estimated by you is higher than 5%, don't invest. Yes, I know this will sound absolutely insane, because you might claim, oh, the whole upside, the whole reason why we invest in microcaps is because, the market doesn't like to invest in risky things. And even, if the company is, 50-50, if it happens or not, the company might go to zero, or 50% of the time the company might go 20x. So this way you might say, oh, this is insane. This is never going to work for microcaps. There's always more risk than that. But, I'm doing this because what I'm going to explain later, but this is just something that I'm personally started to implement about maybe 2 years ago. And, since then I got like way better results. So, this seems to be working. And I'm going to explain like what's going on here. So the main reason why I'm claiming this, and, if you look at, a lot of the papers and a lot of like the psychology of how people tend to perform, humans, and, I as well. So, me included, like all of us are included in here, we tend to be way too optimistic. And, if you ask people, give me like your pessimistic, your realistic, and your optimistic estimates, especially if you do it like with two different groups, the realistic estimates of one group are about the same as the optimistic cases of other groups. So, in reality, people's optimistic and realistic estimates are almost the same. So, that's why they're so bad in investing. When you ask them, oh, what do you think the stock price will be in, 5 years? They're going to say, oh, realistically, it's going to be $100. But in reality, that's their like most optimistic, super bullish case, because that's just how psychology is. And, you can look up papers on that if you want to. Like, there's lots of studies on that. But, it's very well documented that the vast majority of people are highly overconfident about most things. Investors and myself included, obviously. And, I think it's easier to be aware of this fact and just consciously steer away from situation where this will burn you, instead of trying to change your whole psychology, because it's just very difficult, because this is just how we are as humans. So, one thing I personally adapted to, this is not relating to stocks, but to my personal like portfolio management, or, planning out what my portfolio is, whatever. I'm always assuming like the worst case, and I plan things from that. And I was going to explain later here why that makes sense, but this has served me pretty well, because if you plan for the worst case, you make sure that even if things go badly, you're still going to do all right. But if things go better than expected, then you're excited, right? So it's like built-in excitement, I guess. And, this is not super rigorous, but like from a couple of papers I was looking at, the estimates about people's confidence in an answer or time estimate. So you ask people, oh, you have to write an essay, how long it's going to take you? Like, give us a 90% estimate when you think your essay will be done. So people say, 90% chance it's going to be done, 5 to 8 days. And then they take 12 days or something like that. So, in reality, when people claim a 90% confidence interval, in reality, it happens only 40% of the time. 98%, it's like 60, 65. And people say, oh, this has 100% of chance of happening. This is for sure happening. There's no chance this goes wrong. People are only right about 80% of the time. Like, in reality, like, if you want to actually get accurate estimates, you take your most pessimistic assumptions, make them slightly worse, and now you're probably somewhere in the range where you're correct. I'm going to give you a recent personal example right away to show you that I'm not infallible. I do these mistakes as well, but I'm aware that I'm doing those mistakes. So I don't put myself in a position where, me being too overconfident will cost me my portfolio or, blow up in my face or something. But we are all guilty of that. It's very, very difficult to get rid of. So, in a video from the 9th of March on this channel, I talked about Aduro Clean Technologies. And in that video, I said that the pilot plane data for Aduro was going to come out in the next couple of weeks. I gave a couple of time estimates, but my most pessimistic guess mentioned in that video was in 6 weeks. As of the release of this video, it's now been 10 weeks and we had no pilot plane data. So obviously I was completely wrong. To my defense, I should say, I wasn't trying to give a super rigorous assumptions. I was just saying in the next couple of weeks. But, even, just by me saying in a couple of weeks and not a couple of months, I was already off. So, I've been wrong. I've been too confident. And, if I was giving, I could have done better if I actually put in more effort, but it was more like a throwaway line, But, I was giving it ranges between 2 and 6 weeks, but we're now been 10 weeks. So, again, this is reoccurring that people are just too confident. That's just what it is. So why does it happen? Well, we're not 100% sure, but there are a couple, 3 factors that have been shown to explain the observations quite well. So people usually start with the best guess and then adjust outwards to create their 90% to 99% range. And most people don't adjust enough. So the assumptions are too certain. So in my example here, my center, is my best guess was 4 weeks. So, I just expanded the band a little bit. So I said, 2 to 6 weeks. But I should have said, 2 to 12 weeks maybe, or, 1 week to 20 weeks to give an accurate range, but I didn't. And again, I, did exactly this mistake that people discuss in papers, etc. So, we are all not infallible. It's just important to keep these things in mind. So it doesn't, if I was betting my whole life savings on this happening in 6 weeks, I would be broke now, right? But I didn't, because I know that, things very often go wrong. And, this is probably the most important, and I think the reason that explains it the best, because, we easily imagine the ways that we might be right. So, we know exactly what has to happen for a company to 10x in price, let's say. But it's very difficult to imagine all the, there are so many things that can go wrong, and we just lack the imagination or the data or just the knowledge about the subject to, think about all the unforeseen ways we could be wrong. These are the unknown unknowns, right? It's a thing that you didn't even know can go wrong, right? I don't know, when you have a very simple system, exactly, it can only go wrong in these 2 ways. But when it's a super complicated thing, company, and you not only have the company, you have the whole stock market, supply and demand. What if a big short seller comes in and dumps the price down by 50%? You haven't foreseen that, and now the company can't raise money or whatever. There are almost infinitely many ways to how things can go wrong, and we can't just foresee them. That's where we are too optimistic, because we don't see all the ways how things can go wrong. And yeah, this is also a main reason, human confidence scales very poorly with task difficulty. Going from easy to very hard, doesn't reduce people's confidence enough. So, people apply their best guess to a problem, and it doesn't really matter if it's easy or hard. They're, they adjust outwards their confidence interval just a little bit. But, when it's a harder problem, you should be way less confident about predicting, the whole global economy, let's say. That seems more difficult than to predict, the next, whatever, if it's going to rain tomorrow or not. We can predict that quite accurately if it's going to rain tomorrow or not, but what the global economy is going to do over the next 5 years, that seems way more difficult. But people, there are a lot of macro experts that constantly predict things, but no one really ever goes back and looks at their predictions if they actually turned out right or not. And when you look at those, people are just completely wrong all the time, massively wrong. And just because they are slick talkers and are good marketers, people continue listening to people who have been wrong for the last 20 years, every single time almost. And if they get it right, that's more, out of luck and not because they had some cool process. So, a couple of examples here, I think this is yeah, it sounds good in theory, right? That the best investments are investment with at least a 10x upside, where the returns rely as little as possible on flawless management execution. So obviously, you want to invest in companies with how I do it, right? Because this, by the way, applies to people who still need to grow their portfolio a lot, right? If you already have a very sizable, large portfolio, you don't need to get into like these speculative companies. You can go like a lower risk. You can even go like bonds, get like a 5 to 10% returns and be very happy. Like you don't need to do this, right? But when you're still growing your portfolio, you want to find companies that have large upsides and they rely as little as possible on management execution. And I think that's very important. I'm going to explain exactly what I mean by this, but this is like one of the main weak points that I discovered in my last couple of investments that failed. I was relying on management being to do something extraordinary, and if management didn't do something extraordinary, the company would collapse. But because I was overconfident, I thought, it's like a 80-90% chance that he can do it. But when it's something exceptional, it's very rare that the company can do it. But because slick talking CEO, I believed them, and I got burned very hard. So yeah, a lesson here. I'm gonna dive it a little bit deeper here, but yeah, this is like a very, very major factor that really I found as a commonality between failed investments. So the companies I currently cover on my channel are Clean Technologies, and I would say chemistry has been discovered, patented, and it exists, unless you believe all of the positive news so far has been like fake news or invented, or there are scammers or whatever. But the chemistry is the main driver of the value of the company. It's not about how slick the CEO is or how amazing things he can do. It's the chemistry, right? And a good management team is a great bonus, right? Don't get me wrong, like they can drive forwards, the pilot plans, the demo plans, sign, commercial contracts, engage with partners, whatever. But in the end, it's the chemistry. And the chemistry either works or it doesn't, right? It's as simple as that, and the whole value of the company derives from the chemistry. And if the chemistry works, then it doesn't really depend on a CEO to be able to do a backflip or backbreaking work or something super amazing. If the chemistry works, the company is going to be a 50x. And if the chemistry doesn't work, the company is going to 0. It's just as simple as that. And yeah, I think these types of companies are way safer because it's easier to estimate whether the chemistry actually works or not versus if the CEO can do something crazy. And the second company I currently cover on my channel is Oracle Resource Corp. And it's a company that has a mining project that they're not going to develop but sell to a large mine developer. And the ore is in the ground already. It doesn't really matter who the CEO is or who owns the rights to this ore. The ore is in the ground, right? Like the bench can be obviously faster and slower in executing and completing remaining studies to make the asset look greater and a lower risk for big mining majors so they can acquire it. But in reality, as long as the copper, it's dependent on the copper price. If the copper price doesn't completely collapse, someone can still buy the asset without the studies. It's going to be a lower multiple, but the ore is there. Like this investment relies on the ore being in the ground, and the ore is in the ground. So because the ore is a real asset, the drivers of the value are the metal prices and how difficult it is to extract the ore, which is just dependent on what is there in reality. And again, it's a function of rocks engineering and chemistry and not the management. So the management here is pretty replaceable. And you can boil it all down to, I think it's a little bit more difficult, a little bit more complicated than this. But if you want to put it in very simple terms, it's like this Warren Buffett quote: I try to invest in businesses that are so wonderful that an idiot can run them, because sooner or later one will. Right? Like a little bit tongue-in-cheek, but it's really what I was, painfully discovering instead of just listening. Now we are all, we think we are smarter than we actually are. So yeah. If I really took this to heart, I would have understood what it is about. But yeah, this is really like the main conclusion. So for you guys who stuck around to the end, I'm going to reward you with like 4 takeaways for your own investing journey that you can implement. And for the very most committed people, it's going to be a bonus tip that's, I think, it's going to be pretty exciting. So first takeaway is focus on the downside, the margin of safety, and the reliance on flawless management execution. Like we discussed, this flawless management execution, discussed it already. Downside, so how low could the stock price go if things go badly, and margin of safety is related to that. So it's pretty much what's the distance between the current stock price and the downside stock price if things go badly, right? For example, with Clean Technologies, the value is in the chemistry, in the patents, in the trade secrets. And, I would say these are very valuable, especially as they have been proven to actually work in reality. So, I don't think the downside is large here, right? Obviously, stock prices can always move down, but, I think these are very important things to focus on. Second one, that there are many investments with very high upside. So this is what the title of the video related to, that's not the upside that you should pay attention to, but also what's the risk and what's the certainty that this will actually happen. And, you should only invest in 10 out of 10 investments and keep the 9 out of 10 investments on a watch list. Now, I know that this is probably the most difficult to implement in reality. I was struggling with it quite a while. I'm still not perfect. I'm trying, right? Because it's just so tempting to invest in those 9 out of 10 companies, oh my God, there's like a super new hot sector. Oh, this seems super undervalued or whatever. It's just so tempting, but you really want to focus on 10 out of 10 investments only, depending on how exactly you do your due diligence and whatever. But yeah, obviously this means you will be quite exposed to a couple of companies. You will be worse diversified. So because you will only have like a handful of companies in most cases. Right, obviously you will not be diversified well for idiosyncratic risks or risks that affect only a single company. So if the stock market crashes, obviously all companies will probably go down in price. But when something bad happens in one company, if you only have 2 or 3 companies in your portfolio, obviously you are very exposed. But what most people forget about portfolio construction, right? Where people recommend oh, you should have at least 30 companies to be well diversified. Well, the nice thing, the upside of having only 2 or 3 companies is if one company goes up 10x, 20x, well, that's going to make a massive impact to your portfolio. So, obviously you have more downside, but you also have more upside. And I think if you only invest in 10 out of 10 companies, I think it's a worthwhile trade-off. Number 3, I think this is the most important out of all 4. You should just put in your own effort into due diligence instead of relying on stock picks from YouTubers. Yeah, I know, irony, yeah. I know a lot of you guys only watch videos to inform yourself about companies. It's fine. I've been there myself, but I think that this will really maybe, convince you. I don't want to convince you, it's your money. You can do whatever you want with with your money. It's not financial advice, but without your own conviction, a sharp price move in either direction will shake you out. So a lot of people talk about the shakeout when the stock price goes down. So let's say you got your stock pick from a YouTuber, and now the stock drops by 30%, 40%, and then the YouTuber stops talking about the company entirely. What do you do at this point? Do you keep holding on, and then the YouTuber started talking about other companies, or do you sell this loser and buy into the next hot thing that he talks about, or whatever? It's very difficult. But the other directions might be mentally even more damaging. If you have a stock and then in 2 months it goes up by 50%, and you're like, oh my God, this is amazing, I already made 50% in a year. Oh my God, such good returns. Let me sell it to to not lose this upside. And then you sell, and then the company keeps going up and up and up, and now it's up 5x, 10x, 20x, and then you're like, oh my God, if I just held onto this company, I would have been retired by now, but I sold. Oh my God, how I've been so stupid, I messed up. This is mentally, I think, even more damaging than being down 30% and then just selling. Yeah. So if you don't understand the company, you don't understand the real value. For example, as an example here, when Clean Technologies, 1.5 months ago was dipping in price down to about $10, I bought shares, and by now the stock price recovered to $14. So I made 40% returns in 1.5 months. Now, if I didn't have enough due diligence knowledge or just commitment on the company, I would have sold. I would have been, I made 40% in 1.5 months, amazing. But when you do due diligence on this combines with number 2, when you have 10 out of 10 investments and they go up a little bit in price because you want the 10x, the 20x, the 50x returns. 40% up is nothing. The company is still dirt cheap, it still has tons of upside. So this is where really do your own due diligence and learn how to do it, right? Get help from others and just study. And if you wanna stay broke for the rest of your life and never accomplish the goals that you set out to, then keep taking these like cheap, hyped stock picks and don't do your own due diligence, but you will get burned. It's just what it is. I'm just trying to help you guys. And the fourth point, focus a lot on what price you're paying for the company. So this is like, I see this a lot on on investment people discussing things back and forth, and wow, this company is amazing and great, and they're having this super nice technology and they have a moat, it's crazy. And then I'm like, asking them like, what's the market cap of the company? Oh, it's 25 billion. I'm just looking at that like, yeah, I mean, the company is exciting, but it's pretty niche. The business that they're doing is like pretty niche, and they have quite a lot of competitors, and it's like very expensive to build all the factories, and capex is quite high, and it's like not really sure if they have the pricing power. And for $1 billion it might be an exciting investment, but for 25, no, that's already, all of the upside is already priced in, right? Like, for example, this $25 billion company might be like in reality worth 10 billion. So even though the company from here on out executes everything perfectly, the stock price might still go down like 50%. Like, that's just what happens if you don't pay attention to the price. So this is why I say, really, really, really focus on the price as well. But I would say like number 3 here is the most important, do your own due diligence, and then all the other arguments here are important as well. So really focus on the price, only focus on 10 out of 10 investments, and look closely at the margin of safety and the downside, and that you don't rely on management being able to do backflips to justify an investment. Bonus tip for my most dedicated viewers, there's really no shame in getting help and bouncing ideas off other people back and forth. And I see a lot of people talking about investments like they are, their wives or their children, get like married to them. They're like post obsessively about them every day. Like, that's just not healthy. Like, investments or bad ideas in general should be killed. If you realize some flaw in your assessment or the thesis doesn't play out, you sell the company, you move on. Like, it hurts, it will hurt. You will, regret all the time you spend on, watching videos about the company and putting in, time into due diligence, and all the money that you missed out on, you could have invested in something else. But if the investment turned out to be worse than expected, you just sell and you move on. It just is what it is. And, getting help from others is also not a shame, because this is where you typically realize, oh, I wasn't understanding this piece of the company, and it actually, destroys the whole thesis. And if you never talk to anyone, you never find it out. So I know this is a little bit more, me talking behind the scenes. So if you're just in here for the facts and the information and the knowledge, you don't have to keep watching. This is like for the people who care a little bit more about the behind the scenes and are a little bit more, let's say, the hardcore viewers of mine, which I really appreciate, you guys. I'm currently looking at the best way to create a discussion community of like-minded people who share my passion for, like, I would say, like, high return investing and financial freedom, so we can all bounce ideas back and forth. So not only to implement this, but because I think it's just nice when you are in a group of people who are like-minded, who, see things the way you see things, and to give you, like, respectful pushback, right? They don't insult you right away, but they tell you like, hey, I don't think you're thinking about this correctly. What if you think about it this way? And you're like, oh, I haven't thought about it this way. Yeah, you're right. It's probably my mistake, right? So I'm still, in the currently looking phase. Stay tuned for more infos in the upcoming weeks. I think just like with my own videos, which, just a little behind the scenes fact, I like watching my videos back sometimes. It's like kind of fun. I really enjoy them. And this is like what my goal is, that I make videos for myself. Like, or, if I was a viewer, I would enjoy these type of videos. And I want to create something that, I would love to join if I were in the viewer's shoes. So a community where I would feel comfortable and would love discussing things. And there currently is just no community that combines, what I'm talk about, like these high return investing and financial freedom into one, so people can share their own thoughts and research. So, there are these, I would say, like, degenerate gambling people who talk about like microcaps and like penny stocks and whatever. And there are people who talk about financial freedom or independence, but they talk about like boring index funds and whatever. So like both of those, for me personally, are not relatable. I need like kind of the combination of the two is where I feel, at home. And yeah, it's also like where people can not only observe and like, or watch and like and whatever and comment like something, but where people who are actually not content creators, who are just normal people, who can share their thoughts, who can brag a little bit. We all need to brag a little bit about our investments. It's just it's just human nature. We love to brag about successes. I think there's absolutely nothing wrong with that. Just has to be the right place, right? And obviously share some research. Obviously, I don't expect people who are just, part-time investors or like just passionate about it to be able to create like amazing research reports. But, just share a piece of like, whatever you discovered, maybe about your own special situation or some, something about an investment that, maybe it failed and you report on why it failed, and just share your knowledge with other people. I think like a community like that will be really awesome. I think it's going to provide a lot of value to people, and yeah, I think it's going to be great. But stay tuned for that. I'm really excited to do it, and yeah, I will keep you guys up to date. So thank you guys for watching. See you guys next time.